You know, every country's banking system has a story. And it's not just about money, right? It's really the circulatory system of the entire economy. Its health tells you everything about a nation's past, its struggles, and where it's headed. So today, we're going to dive into the story of Uganda's banking sector. And trust me, it's a powerful lesson in finance, politics, and, well, resilience.
Yeah, because when you boil it all down, this whole story is really a lesson about three huge mistakes. Three historical weaknesses that brought an entire financial system to its knees. And understanding them, well, it's absolutely crucial if you want to see how a modern, resilient economy gets built from the ground up. So let's get into it.
But before we get into all the drama, and believe me, there's plenty of collapsing banks and political intrigue to come, we should probably get on the same page. What exactly is banking law anyway?
So it's not some separate, super complicated branch of law that only a few people understand. It's actually a collection of rules from all over the place. Contract law, property law, you name it. It's all just brought together to regulate what banks can and can't do and how they have to treat us, their customers. Basically, you can just think of it as the official rulebook for the most important players in the economy.
All right, with that little bit of background, let's start the story. We're going way back, over a century ago, to the colonial era. And right from the jump, we have to ask the most important question. When these first banks were built, who were they really for?
So the very first commercial bank shows up in 1906. It was called the National Bank of India. And right away you can see the problem. It was led by foreigners, and it was there to serve the colonial administrators and other expatriates. From day one, the system was built in a way that just wasn't designed for the vast majority of people who actually lived there.
And this, right here, is the first huge mistake: systemic exclusion. I mean, for native Ugandans, the doors to these banks were basically locked shut. Why? Well, for one, they didn't have the registered land titles that the foreign banks demanded for collateral. And on top of that, their main line of work, agriculture, was just dismissed as non-commercial and way too risky. So the system wasn't just hard to get into, you could argue it was designed to keep people out. Okay, so fast forward to after independence. The new government sees this huge problem and knows they have to fix it. The solution seems pretty obvious, right? Let's just create our own bank, a bank for the people. But, and this is a big but, this totally well-intentioned solution would, ironically, end up creating a whole new set of problems. Problems that were maybe even more dangerous.
And their answer was the Uganda Commercial Bank, or UCB for short. It was set up in 1965, and the idea was simple. This was going to be the bank that would finally serve all Africans and really power the new nation's economy.
And you know what? For a while, it worked. It was a huge success. UCB started popping up everywhere. By the early 90s, it had this massive footprint. We're talking over 100 branches, and it held half of all the money deposited in banks across the entire country. I mean, think about that. It was, without a doubt, the most important financial institution in Uganda, period.
But that incredible dominance, it was hiding a serious rot deep inside. And this is where we run into the second and third fatal mistakes: political lending and incredibly weak supervision. See, the fact that the government owned the bank made it really, really vulnerable.
Here's the thing. Suddenly, UCB wasn't making loans based on whether someone could actually pay it back. Nope. Loans became political tools. They were handed out as rewards for loyalty. And this is just a classic trap for state-owned banks all over the world, where politics just trumps financial common sense. And what happens when you give out loans to people who have no intention of repaying them? Well, your recovery rates just plummet. Pretty soon, less than half the money the bank was lending out was ever coming back in.
So this is the moment where the perfect storm hits. You have all three of these deep-seated problems: that old legacy of exclusion, the now rampant political lending, and basically zero real supervision. And they all just collide at once. The result? A full-blown crisis that threatened to take the entire economy down with it. So by the early 1990s, just how bad was it at the Uganda Commercial Bank? Get this, 75%, 3/4 of its entire loan portfolio was non-performing, which is just a fancy way of saying nobody was paying it back. The People's Bank was completely broke. And it didn't stop there. The rot started to spread. This wasn't just about one bad bank anymore. It was like a contagion. Because there was no real oversight, the entire system was infected. Between 1998 and 1999, you see this wave of bank failures just sweep across the country, wiping out billions in people's savings and absolutely shattering public confidence.
But Out of the ashes of that crisis came this really painful but totally necessary realization. The whole system had to be rebuilt from scratch. This was the beginning of what you could call the Great Regulatory Shift, a decades-long mission to build a financial sector that could actually last.
And let me tell you, the journey to fix this with new laws was a long one. I mean, it technically started way back in '66 with the creation of a central bank, but the real change kicked off in 1993 with a new law that finally gave the Bank of Uganda some real teeth, some real independence. That was followed by even stronger rules in 2004 and again in 2016, each one adding another layer of what's called prudential supervision, which is basically just a much stricter rulebook to stop banks from taking crazy risks.
So, okay, after all that chaos and reform, what does Uganda's banking sector actually look like today? Well, the changes have created a completely transformed landscape. It's night and day.
And one of the biggest, most important changes is this one right here. Regulators basically forced banks to hold way more capital in reserve. We're talking a 500% increase in just 3 years. Now, that's not just some random number. Think of it like a giant shock absorber for the economy, making sure banks are strong enough to handle a crisis without just collapsing.
The market today is structured into different tiers, but check out the incredible irony here. At the very top, the Tier 1 banks that hold most of the money, 87% of them are foreign-owned. The system has literally come full circle. But, and this is the key, there's one massive difference. This time, they're all operating under a strong, independent, local regulator that's calling the shots.
And that brings us right up to today. We're seeing all these new innovations pop up, things like Islamic banking, which is a game changer for financing things like agriculture without interest, and of course the absolute explosion of fintech and mobile money. And what are they all doing? They're tackling that very first mistake we talked about at the beginning, that huge challenge of inclusion.
Which leaves us with one final and I think fascinating question. After a century of colonial exclusion, a failed state-run experiment, and years of painful but necessary reform, Uganda now has a system that's stable, but it's still wrestling with that original problem. So the big question is, can these new digital tools finally do what all the other systems couldn't? Can they finally build a banking system that truly works for everyone,